Hi everyone, welcome to the channel. My name is Philippe Marie-Jean Robert and I am the founder of Kwajami Financial, an independent firm that provides both financial planning and investment management services to Ontario residents. If you are a returning subscriber, welcome back. If you are new to the channel and would like to learn more about financial planning and investment, please click the subscribe button and the notification bell so you don't miss any upcoming videos. Does your investment strategy involve day trading? If so, I am afraid I have some bad news for you. Indeed, we have today plenty of evidence that even the most sophisticated investment professional cannot consistently outperform financial markets. In fact, a large number of active managers do not even beat their respective index benchmarks in any given year. And so, if you are planning to engage in market timing, in other words, if your investment strategy relies on your ability to figure out which days the market will rise and which days the market will fall, I will strongly advise you that you reconsider your strategy. The good news is that there are other investment strategies, including the smart investing approach I had the chance to discuss in a previous video, that will greatly benefit you as an investor without having to predict the stock market. In today's video, I will share the findings of an analysis I conducted on the Canadian equity market. The analysis looked at the daily returns of the TSX capped Composite Index over the past 15 years. Let's get started. Market timing involves buying and selling financial instruments based on some predictive methods or forecast. For instance, an investor might decide to take a position in the market under the expectation that the market will rise and sell that position at some point in the future when market expectations turn negative. The holding period varies significantly from one investor to the next and can range from a few weeks to a few days, and yes, even a few minutes or seconds in extreme cases. To realize a profit, a buy and a sell transaction must be executed, and the timing of those two transactions must be close to perfect. Predicting a market bottom so you can enter the market remains an extremely challenging exercise, to say the least. And so, if the probability of perfectly timing a market bottom or a local minimum is low, one can only imagine that the probability of perfectly timing both a local minimum and a local maximum would be even lower. And to make matters worse, the margin of error is very slim, and so accuracy will be key to generate sufficient gains to more than offset all associated trading costs. The analysis I conducted looked at the daily returns on the Toronto Stock Exchange over the 15-year period from 2007 to 2021. There were 3,766 trading days in the period for a total cumulative return of just over 147%, despite the financial crisis of 2008, the sovereign debt crisis that followed the financial crisis, and the pandemic that shut down the global economy in the last 2 years of the period. But what is more striking is that your overall return would have been a dismal minus 12% over the entire period had you missed the best 20 days. Let's think about this for a moment. 20 days out of 3,766 days, that's being out of the market for just 1 month over a period of 15 years. It is also worth noting that many of the market's best days occurred within weeks of the market's worst days. These findings are not specific to the Canadian equity market. Similar patterns can be observed in other financial markets as well. This highlights the importance of staying invested despite short term market volatility if your personal circumstances and objectives justify your stock exposure. The bottom line is don't bother trying to time the market. Instead, as an investor, shift your focus on what is under your control. I hope you found this video informative. As always, don't forget to like and subscribe. Thanks for watching and see you in the next video.